I think the real threat is interest rates, though, because if interest rates really start to climb, that's a long-term problem for investors, and that has real. Maybe problem is too strong a word, but it's a long-term challenge, or it's a long-term consideration for investors, and it has impacts on how you value companies, how you do your work as a portfolio manager, how you make your investment decisions. And they could sustain for like a year, 2 years, 3 years. Last week I was thinking about, when we saw the CPI number come out at 7.5%, I was thinking to myself, like, that didn't bother me that much, right? It could have been a little high, it could have been a little low. What we're seeing right now doesn't matter. But I think once we start to see what CPI really looks like, is it really going to sustain at 4%, 3.5%, 3%? Like, that's when it's really going to start to matter. And that's what I'm actually worrying about. And when we're making investment decisions, this is what's being factored in. What's going on with Russia and Ukraine is terrible from a global, geopolitical, humanities standpoint. But from a market perspective and from an investment perspective, that's not weighing into our decisions. Right now, that's short-term noise. That's what I wake up and say, ooh, futures are down. Oh, futures rallied. Why? Because there's that. But that's short-term. That's finite with respect to investment decision-making. The interest rates, that's where things start to get challenging.
Although Mike Wilson over at Morgan Stanley, who, granted, has been a long time bear at this point, Degas, writes that war materially increases the odds of a polar vortex for the economy and earnings. He sees nothing good, obviously, coming out of an attack or invasion of Ukraine, but a bigger impact than what a lot of market watchers are saying would have on our economy. Degas.
Well, Melissa, I agree with Jenny, because ultimately, if you look at when Russia invaded Crimea in 2014, there was very low impact to the U.S. market. Also, even today, Russia has very little impact on our markets. There could be, if something does happen in Ukraine, there could be an impact on the flow of oil and energy in that part of the world. Particularly, it may impact Germany. So we see very little impact of the Russia-Ukraine. And once again, we have to then look at what's the real driver here, and that's inflation. And what we're looking at is that something that we probably haven't talked about in a long time, is really looking at the equity duration, which is the impact of stock returns that are impacted by the interest rates. So we want to start looking at that equity duration, start looking at the company's cash flows, how the discount rates impact those cash flows, and ultimately the growth of those companies. So we're seeing that those long duration stocks that have cash flow well into the future, are the ones that are being most impacted by increasing interest rates. So you want to start looking at those shorter term duration stocks to be able to really be very selective in your putting together your portfolio construction.